Right now, tonight, while you are asleep, your bank is doing something with your money that they are technically required to disclose, but are absolutely not incentivized to explain. And the gap between what they earn using your money and what they pay you for the privilege of using it is one of the most quietly consequential wealth transfers happening in America right now. Not in some abstract Wall Street way. In your specific account with your specific balance. Every single night, my name is Eddie, and today we are going to do something the banking industry spends a significant amount of money hoping you never do. We are going to open the hood on exactly how banks make money, where your deposits actually go, what they earn on them, and what you get in return. Because once you see this math, you cannot unsee it. And once you cannot unsee it, you will never think about your savings account the same way again. Hit subscribe if you want to keep running the numbers that financial institutions would rather stay buried. Let's get into it. Here is the assumption most people are operating on without ever having examined it. You deposit money in a bank, the bank holds it for you. You need it. You take it out. Simple, safe, straightforward, a vault somewhere with your name on a little drawer. That mental model is wrong, not slightly wrong, not directionally wrong, in a way that still captures the general idea. Fundamentally, structurally, completely wrong. And the bank has never once corrected you because correcting you would require explaining what they are actually doing, which would require explaining how much money they are making doing it, which would require explaining how little of that money is making its way back to you. So instead, they give you a free checking account and a mobile app with a roundup feature and a customer service chatbot named something friendly like Penny, and hope you never ask the next question. The entire user experience of modern banking is engineered around making you feel taken care of while quietly taking care of someone else entirely. Here is what actually happens the moment your paycheck hits your checking account. The bank takes that money and immediately puts it to work. Not in a vault, not in a drawer with your name on it, not in some protected digital holding area with a little lock icon. In loans, mortgages, auto financing, credit cards, treasury bonds, and investment securities. Your $5,000 deposit does not sit there waiting for you. It becomes the raw material for a financial machine that generates returns your savings account interest rate would genuinely be embarrassed to look in the eye. This is called fractional reserve banking, and it is the foundational operating principle of every commercial bank in America. It has been the operating principle of commercial banking for over 2 centuries. It is legal, it is disclosed, and it is the reason banks are among the most consistently profitable businesses in the history of capitalism. Here is how it works with actual numbers. Federal regulations historically required banks to hold a certain percentage of deposits in reserve. In practice, after the Federal Reserve eliminated reserve requirements in March 2020, many large banks operate with reserves of around 10 to 15% of deposits. That means for every $100 you deposit, the bank is able to lend out $85 to $90 of it immediately to someone else, while your account still shows $100. You and the borrower both believe you each have access to that money simultaneously. And in normal conditions, that works fine because not everyone withdraws everything at once. But let that sink in for a moment. The number on your screen and the actual physical money those numbers represent are 2 very different things. You have a claim on money. The bank has the money. And those are not the same thing. And the distinction matters more than most people ever realize until it suddenly matters enormously. Now let us talk about what the bank does with the money it lends out. Because this is where the math starts to get genuinely uncomfortable. The average interest rate on a 30-year fixed mortgage right now is around 6.5 to 7%. The average auto loan rate is between 7 and 11%, depending on credit score and loan term. Credit card interest rates have climbed to a record average of 21.5% as of late 2024, the highest they have been since the Federal Reserve began tracking this data. Personal loan rates average between 11 and 20%, depending on the borrower. Small business loans can run anywhere from 6 to 30%, depending on the institution and the risk profile. And buy now, pay later products, embedded in retail checkout flows, are generating effective annual rates that sometimes exceed 30% on short-term balances. So your bank is deploying your deposit money into products, earning them somewhere between 6 and 30% annually. Some of your money is in mortgages at 7%. Some is funding credit cards at 21%. Some is in car loans at 9%. Some is sitting in treasury securities, earning 4.5% with 0 credit risk. The blended return on a typical large bank loan, an investment portfolio, runs somewhere between 8 and 12% annually on the earnings side. Now here's the question you need to sit with. What is your savings account paying you in return for providing the raw material that makes all of this possible? The national average savings account interest rate right now is 0.41%. Not 4%, not 4.1%, 0.41%. The bank is earning 8 to 12% on money that belongs to you and paying you 0.41% for the use of it. That gap, that 7 to 11 percentage point spread, is called net interest margin, and it is the single most profitable engine in commercial banking. It is also the most politely hidden transfer of wealth in everyday American financial life. Hidden not through deception, but through design, through simplicity, through an interface so clean and friendly that the underlying mechanics become genuinely invisible to the people funding them. Let us put some real numbers on this, because abstract percentages have a way of feeling abstract. Say you have $25,000 sitting in a standard savings account at a big national bank paying the average 0.41% rate. At the end of the year, you have earned $102.5 in interest, $102.50. Meanwhile, your bank has deployed the roughly $21,000 to $22,000 they were able to lend from your deposit into their loan portfolio, earning conservatively 8%. That generates approximately $1,720 on just your portion of their lending activity. They kept $1,720. They gave you $102, and they sent you a notification about it with a little confetti animation in the app. The ratio of what they earned to what they paid you is roughly 17 to 1. $17 earned for every $1 returned. And if you are at one of the largest national banks, JP Morgan Chase, Bank of America, Wells Fargo, that ratio may be even wider, because their scale allows them to access even cheaper funding and command even better lending rates on the other side. Now multiply your $25,000 across the 150 million or so Americans with deposit accounts at large commercial banks, and you begin to understand the architecture of one of the most efficient wealth transfer mechanisms ever quietly assembled. Perfectly legal, thoroughly disclosed, almost entirely invisible to the people. It is extracting value from every single day. Now, let us look at what happens to that math over time, because this is where it stops being a curiosity and starts being an actual financial problem. If you leave $25,000 in a standard savings account, earning 0.41% for 10 years, you end up with approximately $26,040. You earned $1,040 over a decade. Inflation over that same period, assuming a conservative 2.5% annually, has reduced the purchasing power of your $25,000 by roughly $5,500. So in real terms, in terms of what that money can actually buy, you lost ground. You did not break even. You did not tread water. You went backwards, while your bank used your deposits to generate somewhere in the range of $20,000 to $25,000 in lending returns over that same decade. That is not a minor inefficiency in the system. That is the system working exactly as designed. The design just was not made with your wealth accumulation as the primary objective. Let us meet someone. Her name is Sandra. She is 34, works in supply chain management, makes $72,000 a year, and she is genuinely responsible with money. She budgets carefully. She does not carry credit card debt. She has been building her savings consistently for several years, and she feels reasonably good about where she stands. She has $31,000 spread across her checking and savings accounts at the same national bank she joined in college because the branch was near campus, and she never had a compelling reason to leave. She has her direct deposit set up there. Her automatic bill payments run through there. Her emergency fund lives in their savings account, earning 0.35%, because the bank she joined at 22 is now one of the ones paying the least competitive rates in the country. Sandra is not careless. She is not financially illiterate. She reads articles about money. She has a Roth IRA she contributes to inconsistently. She is doing more than most people, and she still has not thought carefully about this particular arrangement, because nobody in her financial life has ever given her a reason to. Here is what her bank is actually doing with her money right now. It is using approximately $26,000 of Sandra's $31,000 in productive lending activity, mortgages, auto loans, credit cards, and investment securities, conservatively generating around $2,000 annually on her deposits at an 8% blended return. In exchange, Sandra receives $108 in interest for the year. The bank nets approximately $1,892 on Sandra specifically. Sandra has been a customer for 12 years. The bank has netted somewhere in the neighborhood of $15,000 to $20,000 over the course of that relationship on her money, with her risk serving as the backstop, while she believed the arrangement was essentially neutral storage with a debit card attached. Sandra is not a victim of fraud. What the bank is doing is completely legal and thoroughly disclosed in documents she agreed to and did not read, which is true of virtually everyone who has ever opened a bank account. But Sandra is also not in a neutral relationship. She is a net exporter of wealth to an institution that markets itself to her as a partner in her financial life. The free checking account is not free. It is compensation. The mobile app is not a service. It is a retention tool. The fraud alerts and the customer support line and the personalized financial wellness tips in the quarterly email newsletter are not evidence of a relationship built around Sandra's best interests. They are the cost of keeping Sandra from asking the question she is never quite prompted to ask, which is, why am I here specifically, and what is the actual return on this arrangement? Here is the part most people have never thought about, and it reframes the entire banking relationship once you see it. Banks do not just lend your deposits to mortgage borrowers and car buyers. They also invest them directly in financial markets. Large commercial banks hold enormous portfolios of treasury bonds, government agency securities, and mortgage-backed securities on their own balance sheets. In 2023, the four largest U.S. banks held a combined investment securities portfolio of over $2 trillion. These portfolios earn yields ranging from 3 to 5%, depending on duration and the composition of holdings, which means some meaningful portion of your deposit is sitting in a treasury bond, earning the bank 4.5%, while your savings account pays you 0.41% for the deposit that funded it. The bank borrowed your money at 0.41% and lent it to the United States government at 4.5%. No credit risk, no underwriting, a clean 4-point-something% spread on a riskless transaction funded by your checking account. And that is the conservative end of what banks earn on their investment portfolios. When the Federal Reserve raised rates 11 times between 2022 and 2023, something fascinating and genuinely infuriating happened simultaneously on both sides of the bank ledger. Loan rates went up immediately. Credit card rates jumped within billing cycles. Mortgage rates climbed within weeks. Auto loan rates followed almost in real time. Savings account rates went up slowly, selectively, and only partially. The Fed funds rate went from 0.25% to 5.5% in 16 months. The average savings account rate went from 0.06% to 0.41% over that same period. Loan rates tracked the Federal Reserve almost perfectly. Deposit rates absorbed maybe 6% of the total rate increase and passed it along to customers. Banks captured the rate hike completely on the earnings side and shared almost none of it on the paying side, and the earnings reflected that asymmetry with brutal clarity. JP Morgan Chase reported net interest income of $89.3 billion in 2023. A record Bank of America reported $57.5 billion. Wells Fargo reported $52.4 billion. Combined, the three largest U.S. banks earned approximately $200 billion in net interest income in a single calendar year. Net interest income is the technical term for the gap between what they earn on your money and what they pay you for it. $200 billion in a single year, from a spread that most of their depositors have never once examined or questioned. Now let us talk about 2008 for a moment, because that crisis is the clearest window into what happens when this system gets pushed past its structural limits, and what it reveals about who is actually taking on the risk in this arrangement. In 2007 and 2008, banks had taken fractional reserve lending and turbocharged it through the securitization market. They were not just lending your deposits once. They were packaging those loans into complex securities, selling them to investors, recovering the capital, and then lending it out again at even higher leverage. The leverage ratios at some of the largest institutions reached 30 to 1. For every dollar of actual deposits and capital, they had deployed $30 into the mortgage market. When housing prices fell and mortgage defaults rose, the entire chain unwound simultaneously and catastrophically. Bear Stearns collapsed in March 2008. Lehman Brothers filed for bankruptcy in September. The credit markets froze, and the government authorized $700 billion in emergency bank bailout funding through the Troubled Asset Relief Program because the alternative was every checking account in America becoming inaccessible within days. The thing that protected your direct deposits and your checking account balance was not the bank. It was the Federal Deposit Insurance Corporation, the FDIC, a government entity funded by bank premium assessments that guarantees deposits up to $250,000 per account category. The bank took the risk. The government designed the backstop. You provided the raw material, and the profit flowed upward during the good years, while the loss got socialized across taxpayers during the bad ones. That arrangement has not changed meaningfully since 2008. The leverage limits are tighter, the stress testing requirements are more rigorous. But the fundamental structure remains. Banks profit from your deposits in normal times, and the government absorbs the catastrophic downside when the bets go wrong. You are the foundation of the entire structure, and you are compensated like a foundation, which is to say you hold everything up and nobody thinks much about you unless something goes wrong. So what does this actually mean for you in practical terms? Because information without a corresponding action is just interesting trivia, and your financial life deserves better than interesting trivia. The first thing to understand is that not all deposit accounts are created equal, and the differences between them are not small. High-yield savings accounts at online banks and credit unions are currently paying between 4.5 and 5% annually on deposits. Same FDIC insurance up to $250,000, same accessibility, and same federal protections as any traditional bank account. The only meaningful difference is that online banks have dramatically lower overhead costs. No branch networks to maintain, no thousands of tellers to pay, no prime real estate on every corner of every city in America. And they pass a portion of those operational savings back to depositors in the form of interest rates that actually compete for your money. If you have money sitting in a big national bank savings account, earning 0.41%, and you move it to a high-yield savings account, earning 4.8%, you have not taken on any additional risk. You have not made a complicated financial decision. You have simply stopped subsidizing the difference between what banks earn and what they pay. On $25,000, that is the difference between earning $102 per year and earning $1,200 per year. That is $1,100 in additional annual income that requires filling out one online form and waiting 3 to 5 business days for the transfer to clear. The opportunity is that simple. The reason most people have not taken it is that nobody in the banking relationship has any incentive to point it out to them. The second thing to understand is the question of what money should and should not live in a bank account at all. Because this is where most people are leaving the most significant amount of value on the table. Your emergency fund, the 3 to 6 months of living expenses you keep liquid for unexpected situations, belongs in a high-yield savings account where it is accessible, insured, and earning a rate that at least partially keeps pace with inflation. That is the right tool for that specific job. Money you will not need for more than a year, money that is genuinely long-term in nature, belongs in the market. In low-cost index funds, tracking the broad stock market, in treasury bonds, and I-bonds, in instruments that actually compensate you meaningfully for the time value of your capital. Every dollar you leave in a standard savings account for 5 years earning 0.41% is a dollar that has lost ground to inflation, being deployed by the bank at 8 to 12%, and returned you roughly nothing in exchange for any of that. The math on that passive inaction compounds negatively over time, just as surely as good investment decisions compound positively. The bank is compounding on your behalf. It just happens to be compounding for their shareholders, rather than for you. The third thing is the most important, and the most uncomfortable, because it requires changing how you fundamentally think about the relationship. Banks are not your financial partners. They are corporations with shareholders, quarterly earnings targets, executive compensation tied to return on equity, and an incentive structure that is not designed around your wealth accumulation. That does not make them villainous. It makes them exactly what they are, which is businesses that have built an extraordinarily profitable model on the spread between what they pay depositors and what they charge borrowers and investors. Knowing that does not mean you should not use banks. It means you should use them deliberately and with a clear understanding of what you are actually agreeing to every time you deposit a paycheck or leave a balance sitting in a savings account, earning nothing. Your operating cash belongs in a checking account. Your emergency fund belongs in a high-yield savings account, earning a competitive rate. Your investment capital belongs in the market compounding, at a rate the bank is currently earning on your money while paying you almost none of it back. Stop letting inertia make these decisions for you. Inertia is extraordinarily profitable for bank shareholders. It is extraordinarily expensive for everyone who never thought to question the default arrangement they signed up for at 22 when the branch was near campus and the free checking account seemed like a good deal. Here is the reframe I want you to leave with tonight. While you sleep, your bank will use your deposits to fund mortgages, auto loans, credit cards, government bonds, and investment securities. It will earn somewhere between 8 and 21% on that activity depending on the product mix. It will pay you 0.41% and send you a monthly statement formatted to look like a service rather than a transaction. It will offer you a budgeting tool and a fraud alert and maybe a roundup savings feature that deposits your spare change into the same account, earning 0.41%. And none of that is illegal. None of it is hidden exactly. It is just structured in a way that makes the underlying economics genuinely invisible to the people funding them. You are not powerless in this arrangement. You can move your savings to accounts that actually compete for your deposits. You can separate your emergency money from your long-term money and treat each accordingly. You can understand the difference between what banks do and what they tell you they do and make decisions based on the former rather than the latter. The math is not complicated. It never was. The system just runs most efficiently when the people providing the capital never sit down and run it. Now you have. Drop a like if this changed how you think about your bank account. It genuinely makes a difference.